you are welcome to our next lecture on advanced investment appraisal. So we are looking at investment appraisal, but we are looking at the advanced form of that investment appraisal. We've already done the basics, so you know you have idea about how the basic is. We've done something about annuity and perpetuity, how to do it. So now we're looking at advanced investment appraisal. All right. Now, in advanced investment appraisal, we are going to look at inflation, the impact of inflation in investment appraisal. Not only inflation, we are going to talk about how we do working capital movements, so incorporation of working capital. We are going to look at how we deal with our assets replacements, because sometimes the assets are replaced. 4, we will be looking at how to deal with residual values in investment appraisal. All right. And we will be looking at what we call capital allowance. All right. We'll be looking at what we call capital allowance in the investment appraisal. All right. So, 5th one, we'll be looking at something like the impact of taxation first, taxation. And we will end with, since there is taxation, it comes with the capital allowance. So the taxation brings in the capital allowance. So these are the 5 things we are going to do in advanced investment appraisal. Hopefully we finished it in this video. Okay, so now let's start. See, we did basic investment appraisal, but one thing you need to understand is that investment appraisal is also called capital budgeting. All right, capital budgeting. And as you are doing the budget for your entity, you need to be mindful that the figures that you put into your investment appraisal to do, those figures can be inflated. Inflation can affect them. So we are looking at first the impact of inflation. So the first thing we will take to look at will be the impact of inflation. So 1, look at the impact of inflation. What is the impact of inflation on investment appraisal? We all know and we have all heard of inflation. Inflation is the general price increase in the general prices of goods and services. So you will see that inflation, as I've said, is an increase in general prices. In prices, the general prices. All right, so let me situate it well. All right, the general prices of goods and services. Now, what inflation basically does is to decrease the values of your money. Inflation decreases value. As the prices of things go up, your money becomes start becoming worthless. So when this happens, what you see is that there will be a decline in the real values of your money. And we all know now you may have 500 Ghana cedis. You think you have money. By the time you realize inflation has come and your 500 Ghana cedis can't even buy anything. All right. So because of inflation, we need to shift from the real values and go to the nominal values. Nominal values. Now, the nominal values are those values that already includes inflation. So that is that. So there are two ways of dealing with the inflation. You can decide to include the inflation inside your cash flow, which we call that one the nominal values. So anytime you hear nominal values, please understand that it includes inflation. Another name for nominal value is money terms. All right, money values or money terms. Then we also saw that we have real terms. Real terms, another way of calling them is current terms. Current terms or year zero term. Year zero term. All right, or today's value. Okay, or now, the values now. All right, all those things mean that the thing is real. So like I've shown you, this one, the money values, they include inflation. They include inflation. So the cash flows here includes inflation. All right, so that is that. But this one, it does not include inflation because it is at the year zero term. They do not include inflation. They do not include inflation. So basically, that is the distinction. But if you get a question, and this is your exam tip, please, if you get a question where the inflation rate in the question is more than 1, so used when inflation rates in the question is more than 1, then it means you have to use money terms to do your investment appraisal. But if the inflation rate is 1, so where there is a single inflation rate, you can use the real term. All right, so that is that, because every figure is inflated, all right, together. So this is what you have in the manual. I think that when you go to around page 137, you will see what I'm talking about. So this is it. So you have this diagram that I've done for you. So when to use money or real rate, is there one rate of inflation and no tax in the question? If so, then if the answer is no, then it means you have to use the money rate. That means that the inflation rate in the question is more than 1. So if there is only 1 and there is no tax in the question, if your answer is yes, then it means that you have to use the real cash flows. All right, so that is that. So please, if the cash flows are in real terms, all right, you use as such. Any question at this point? So if there is no question, the next thing for me to show you is how to get your money rate and how to get your real rate given the other. So we are going to use the international Fisher effect to determine the money rate, the international Fisher effect. Now, what does the international Fisher effect say? The international Fisher effect explains the relationship between the nominal rate and the real rate. So it says that if you have the real rate, 1 plus the nominal rate or the money rate will be equal to 1 plus R, which is the real rate, multiplied by 1 plus I, which is the inflation. All right. So basically, that is that. That is that. So that is how you go around it. So if you want the money, I mean, you know what to do. You will just have to move this one to this side. So technically, what we are saying is that M therefore will be equal to 1 plus R into bracket 1 plus I. Once you finish multiplying everything, you minus 1. All right, so that is how you can find it. If you are also giving the money rate and you want the real rate, we know that from this equation, we can even write 1 plus R is equal to 1 plus M all over 1 plus I. So you can also do that. So therefore, if you want to find R, R can be 1 plus M all over 1 plus I all minus 1. So that means you brought the 1 here. So that is how you can find the International Fisher effect. All right, so let's take an illustration as usual and learn how to deal with these kind of situations. All right, so let's take our illustration. So this will be our first illustration, illustration 1. All right, the illustration 1, I want everybody to do it now. Find the money rate with the equation that is in front of you. Everybody, use the formula that we just did and use it to find the rates. The question says that find what is the money rate of return, or what money rate of return will he require. All right, so I'm waiting. This one should be quick. Everybody fast with it. What did you get?
15.5%.
Come again, please.
15.5%.
15.5%. Everybody, is that what you had? You said you have 15.5%. Is that what you had, Colinius? Cornelius.
Yes.
All right. So per the formula, if we want the money rate, it is 1 plus M is equal to 1 plus R, 1 plus I. Therefore, the M is given by 1 plus R, 1 plus I, or minus 1. So per the question, the real rate is 10. So that makes this side 1.1. The inflation is 5%. That makes this side to also be 1.05 or minus 1. So 1.1 and 1.05 gives you how much? That gives you 1.155. So if you say minus 1, the final answer is 0.155. That is true, 15.5%. All right, so that is that. So in a question, you need to find out and do it as that. Now look at this illustration. Illustration 2. We have a project requiring an outlay of 1.5 million in year 0 and will pay cash flow in real terms, today's terms. Please, if it is in today's terms and you check the question and the inflation rate is more than 1, then please, you have to convert it to money terms like we have explained earlier. But if the inflation rate is just 1, you can actually keep it. But at your level, you won't get a question where the inflation rate is just only 1. It will be more than 1, so that you might have to convert it. So be careful. And I will show you that when the discount factor that is, listen, this is the trick. If the cash flows that are giving you, if the cash flows are in real terms, then technically you should be doing it using a discount factor that is also in a real term. If the cash flows are in money terms, which is nominal terms, then it means that the discount factor should also be a nominal rate. So if a question now gives you cash flows in real terms and the discount factor is in nominal, you should know that you have to convert the cash flow or you have to convert the discount factor. So please, that is how it is. So just be very, very careful. If you look at this, they told you that the cash flows that you have are in real terms. Another way of saying this is today's prices or year zero terms. I've already given you all the synonyms to that. And so if the cash flows are in real terms, then the company said that the money cost of capital is 15.5. Appraise the project if inflation with inflation of 5%. Now, since inflation is just only one in the question, then it means you need to convert the real cost, the money cost of capital to real. How are you going to do that? Per that same formula that you had, 1 plus M, which is equal to 1 plus R, 1 plus I. If you want the R, the real rate, you just divide this side by 1 plus I, this side to 1 plus I, so that you can cancel this one away. And so therefore, your 1 plus R will be equal to 1 plus M all over 1 plus I. And so therefore, if you want your R, it just will be R1 is equal to 1 plus M, 1 plus I, or minus 1. So that is that. In this question, the money rate was given, which was what? 15.5, right? So it means 1.155 over I, which is 1.05, or minus 1. Please, what will you get? This is what we did earlier, so it's likely to be 10%. All right, so that is that. Now, if you now have your real, you can now set up your MPV and do your year 0, 1, like what you see here, year 0, 1, 2, 3. Put in the cash flows and you can PV it at 10 and get these figures. All right, so, but if you want to also do nominal, you can keep this discount factor. It's just that you have to inflate these figures using the inflation rate. All right, so you multiply this one by 1 plus R raised to the power 1, like you can see, raised to the power 2 because it's the second year, raised to the power 3 because it is the third year. All right, this is how you go about it. All right, any question, any confusion about that? Any question or any confusion? All right, so that is how you treat inflation. All right, so be careful about that. That is how you treat inflation. The next thing we need to learn how to do, the second thing, remember we are doing 5 things. The second thing we need to learn how to do is working capital incorporation. Please, I hope by now everybody knows working capital. When we say working capital, what are you looking at? Which part are you looking at? What is working capital? Yes, when we say working capital, which part are we looking at? Which part of your balance sheet is the working capital? Okay, Steven says he is driving. So working capital we learned is the embodiment of your current asset and what? Please, and what?
Current liabilities.
Current liabilities. We even go to the extent of learning that current asset minus current liability is equal to our working capital. And so when we were doing working capital, we did the inventory plus the receivables, then minus the payables. That gave us our working capital. So that is how we do working capital. All right. So now we are going to look at how working capital works in investment appraisal. All right. So now in the working capital, we should understand that an investment in a new project requires additional investment in working capital. That is the difference between the short-term assets and the liabilities, what we have explained. Now, in treating working capital and investment appraisal, what you are going to do is that the initial investment in working capital is at cost at the start of the project, but sometimes, depending on the question, they can tell you that the working capital started in year 3. So you have to be careful. Now here, the relevant cost here is incremental. We are looking at the incremental cost. Don't forget, we are looking at incremental cost. DCFs use relevant costing. So we are looking at incremental cost. So let's say if year 1, I put in working capital of 1,000. Year 2, working capital is 1,005. Year 3, 2,000. Year 4, 2,500. Then what you are going to do is that you are going to do the incremental. So the incremental will go like this. That means in year 0, there was nothing there. So the incremental movement will be like this. You do the movement like this, which means 0 minus 1,000 will be minus 1,000. Here will be minus what? 500. Here will be what? Minus 500. And here will be minus 500. That is the second point we are making. If the investment is increased during the project, the increase in the relevant cash outflow is the working capital. So that is what I've done. Then the last statement, ESFWA, your hand is up.
Thomas, you're going a bit too fast.
Oh, really?
Mm.
So is it causing you not to understand anything? So, like, if you don't understand a part, you let me know, but I will slow down as you are saying. So this is step 1, is to do the working capital. Set it out like this. You can see, all right, and I will show you with examples so that you understand further. But at the end of the project, the working capital will be released and treated as cash inflow. So at the end of the project, all the working capital you will do, you add it up. So this one is 1,000 plus 500 plus 500, that is 2,000, right? Plus another 500, 2,500. Now here you keep it as an inflow. So if you check, this row, the summation of this row is always 0. All right. So that is that. Now let's look at an example so that you can appreciate what I'm trying to do. All right. So now look at this one, illustration 3. Okay. It says the company expects sales for a new project to be 225,000 in the first year. All right, growing at 5% per annum. The project is expected to last for 4 years. Working capital is, please, everybody should pick calculator right now. We are coming to start working. Working capital is equal to 10% of the working capital equal to 10% of the annual sales is required and needs to be in place at the start of each year. Calculate the working capital for incorporation in the investment in the NPV calculation. So we are told that working capital is 10% of the annual sales, according to the question. But what is annual sales? So we have how many years? 4 years. So you have year 1, year 2, year 3, year 4. We are told that the inflows is, or the sales is 225,000 first year. What would the second year be? We are told that they grow 5% each year. So what would the second year value be, please?
220, 236,250.
236,250. So all you had to do is to do 1.05 multiplied by 225. All right, then it will grow another 5%. What will you get?
You get 248,062.50 pesos.
0.50 pesos. The next year, it will grow again, 5%.
260,465.63 pesos.
260,465.63.
Yes.
All right, so these are the sales, and you were told that working capital is, the working capital is 10% of these figures. So working capital that you have, if you do your 10%, the first one, 10% of the first one is 22,500.
22,500.
This one is 23,625. Is that not it?
Yes, yes.
This will be 24,806.25, right?
Yes.
This is 226,046.56. Is that not it?
Yes, sir.
These are the 10%. Then how did we say we do the working capital movement? So that means that in year 0, there was no working capital. That means that in year 0, there is no working capital. So if this is year 0, here will be 0. So we said that you do the movement like this. This is how you do the movement. And in the last year, you recover all of them. So that means that this one will be 22,500 negative, because 0 minus this is negative. This one and this one, what will you get? Negative, what will you get?
Negative 1125.
1125. The next one, this one versus this.
Negative
Negative
1181.25.
All right. Next.
Negative 1240.31.
Then in the last year, you recover everything. So you add this one plus this one plus this one plus this one, then you put it there. I think it should give you 26,046.56, the figure that you see here.
Yes.
All right.
20.
Exactly. So that is how the working capital incorporation looks like. All right. So all you need to do is to be very, very careful what the question is requesting for you to do. So that is what you do. All right. Your figures and these ones are the same. It's just that these ones were rounded. All right. So basically that is that. So can you work this one on your own? I need a working capital incorporation. You are doing it by yourself. Everybody. The only figure that I will request from you to give me after you are done will be the working capital in the various years. So everybody should practice this one. I'm giving you 5 minutes because we are now learning. So work it and let's see.
Yeah.
All right. So give me if you are done, give me your figures.
I have for the initial starting point, year 0, 30,000. Year 1, 2,400. Year 2, 2,600. Year 3, 35,000.
It's
Inflow.
up. Is it up to year? This one is inflow. So all these things are out.
Year 3 is 34,992.
You had 34,992.
I had
But your year,
I had after the 2,400.
I'm listening on.
After the 2,400, I had 2,592, and then the total 34,992.
Why is it that Colinius you rounded something, or that's what it is? So it said a company anticipates sales of 100,000 units per year. The selling price is expected to be 3 cedis in the first year, inflating by 8% over the next 3 years of the life period. Working capital is 10% of the annual sales at the start of each year. How many years are we looking at? 3 years. So if you did your year 1, your year 2, your year 3, the sales unit here was 100,000. So with the price of 3 at year 3, here would have been 300,000. And this one inflated by 8%, right? It says that in the first year, an inflation of 8% per annum. So 8% per annum. So it means 1.08 multiplied by 300. That gives you 324.
324.
Then you will inflate it again by 1.08. That gives you how much? 349
49920.
920. So if the working capital is 10%, 10% of this gives you 30,000. 32,400. Then 34,992.
492.
So by movement, that tells you that technically you are zero, there was nothing. So if you do your working capital shiftings, you will have, like you said, negative 30,000, 2,400. But here, let's get it right. So what do you have? 32,400 minus 34,992. So that is 2,592. So
920.
no, it's just 2,592. There's no zero. So when you add this 3, you will
Yeah,
have
259.
34,992. All right. So basically that is it. So Cornelius, how did you get this one?
I inflated the price for multiplying with the quantities.
You inflated
The price per unit.
Yeah. Before you multiply by the that's how it's supposed to be actually. Is that
Yes.
not what we just did?
No. You started multiplying with the. You didn't. You just look at the value.
The price increased. So yeah. So this is it. Sorry. Let's do it well. I thought that is what we just did. The price is what is inflating. So yeah, one price will be 5, right?
Yes.
Yeah,
Correct.
2 price, you have to increase it by 8%. So 1.08 by 3, multiply by 3. Is that not it?
Yes.
No, it's not 5, it is 3.
It's 3.
This one is 3. So when you increase it, it's the same thing. 33.24.
3.4.
Exactly. So you multiply by the 100. Now, if you inflate this one again by 0.08, what are you getting?
You get 3.449.
3.4492. So it's the same thing we did. So if I understand you carefully, when
Yes.
you rounded it, right?
Yes.
He
Because
rounded it up.
That is what he did. So it's
Yes.
supposed to be 3, and so that is so it's just a matter of that issue. All right. As for FM, it is plus or minus, plus 1 or minus 1. So you would have been marked the same thing. All right. So that is good work. All right. So this is it. All right. So that means you've learned how to do inflation, and you've learned how to also do working capital. Now, yes, please.
Please, we have a
All right. Go ahead. If I looks as if your line is no good. So I'll be
So I'm sure maybe you mentioned it at the beginning of the video when I was not here. Our investment.
Your line, I don't know. Maybe you have to check, but you can come in anytime and ask the question. All right. When you come, go straight to the question. It looks as if your network is no good. The third thing we want to look at, don't forget we are looking at 5 things, but we will end probably with the 4th one, asset replacement. You know, one thing you need to understand about asset replacement is that asset replacement may happen in the course of the project that you are doing. All right. Now, anytime you replace an asset, the replacement cost should be treated as an outflow. Take note of that. It should be treated as an outflow in their respective years. But sometimes be careful because asset replacement is also a capital expenditure. So check the year because it might also be at year 0. Be very, very careful about it. Check it. Other than that, you might make a mistake. So that is the thing about an asset replacement you need to understand. All right. So it is an outflow and it may be a capex. Now, let's take a look at this question and we will take a look at this question. But before we take a look at the question, also understand that you may also get a residual value. Now, be careful about residual value because residual value is an inflow. But you see, residual value is the money you get when you dispose the thing. So the inflow that you get, but be careful, the residual value is supposed to be a post-tax. Residual value is supposed to be post-tax. Should be post-tax. If it is not post-tax, if it is pre-tax, you have to make it post-tax. All right. So it should be post-tax. So if it was given to you as pre-tax, you have to multiply it by 1 minus t so that you can get the post-tax. So that is how you get post-tax. All right. That is how you get post-tax. If it is pre-tax, you can arrange it. If tax come beneath, then you multiply everything with the tax rate. And we will look at an example about what I have just said in the next meeting. All right. But let's try and do this question.
Sir, so with this residual, like if it is pre-tax, can we just decide to add it before you now take the charge, the tax, the total cash inflow before you now tax it?
Come again.
If it is a pre-tax,
Mm-hmm.
do you need to just add the residual value to the cash flows for that particular year before you charge a tax?
Yeah.
Oh, okay.
So the tax must also be evident in the investment appraisal that you are doing.
Okay.
So you don't work it on your calculator and bring it. You must show it also on the workings. Is that okay?
Okay.
All right. Are you back? Can you ask your question? Is the network better now?
But
Uh-huh.
I think I've understood it on my own.
Oh, you've gotten it. But what was the issue about?
Yes, it was about how we were working out the working capital investments, but I think I've understood.
Oh, okay. Okay. All right. So now let's pick this question. It has everything in it. Everything we've done today in it. And so let's see if we've really gotten the concept well and we can use it to solve the question. All right. So this question says that a company is considering investing 4.5 in a project to achieve an annual increase in revenue for the next 5 years of 2 million. So it tells you that the capital expenditure will become the 4.5. Is that not it? And your money that you'll be getting over the course of the 5 years, each year is 2 million. And it says that the project will lead to increase in wage cost. So there's another cost of 0.4 per year. And will also require an expenditure of 0.3 per year to maintain the level of the existing assets to be used on the project. So that's another expenditure. Additional investment in working capital is equal to 10% of the increase in revenue will need to be in place at the start of each year. And that is something you must also understand. It says that the following forecasts are made at the rate of inflation. You see, the rate of the inflation is many, and all the cash flows is said to be real terms. So what do you think we should do from the first thing we learned today about inflation and all? What do you think we should do? Yes. What will we do? So the cash flows are in real terms, and the inflation in the question 2 is more than 1. So what do? We did this thing from the beginning of the class. Yes.
We need to find a nominal discount rate.
We need to find the nominal, and the so I told you that if the cash flows are real, your discount factor too should be real. If the
Yes.
cash flows are supposed to be nominal, your discount factor too should be nominal. The real cost of capital is what they give, and the inflations are more than 1. I told you that if the inflation is more than 1 in the question, you use the nominal or the money rate. So it means that we need to convert the discount factor we will have to use in answering this question has to be nominal. So, and we said the nominal money rate will be equal to 1 plus R, 1 plus I, all minus 1. So now, what is the real rate? We know the real rate is 1 point. It will be 0.8 because it's 8%. Then the inflation, this is the general one. This is the general one. These are specific. Inflation is the general increase in prices. Don't forget definitions. So here will be 1.065, all minus 1. Please, what will we get? What will be the money rate?
%15.02%.
15.02%. So if we are rounding it, let's say 15%, okay? Because you won't get 15.02% from the table. All right. So that is that. We have dealt with the rate part. We need to also do our working capital before we even start everything, because working capital will be needed. So now we are told, so if you check how many years is this project? 5 years. So 1, 2, 3, 4, and 5. So they said that working capital is 10% of the increase in the sales. What is the sales? What is the sales figure? You see, we are told increase in the revenue. The increase in the revenue is 2 million. And they said that this 2 million is quoted in all cash flows are quoted in real terms. So that tells you that this 2 million is at which year's own is that? Which year's own is that?
That's year 0.
Year 0. So it means that if you want your year 1, you need to increase it by 10%. So 2 million to be increased by 10% will be what? That is 2,200, right? Then every year is 10% per annum. So now do the year 2 for us. So how do you do that? You just do 2,000 multiplied by 1 plus r raised to the power n. So the n, this is 1. If you do it again, year 2, you put 2. If you do it again, year 3, you put 3. If you do it for year 4, you put 4, like that. All right. So basically, that is that. So you can do 2,200 multiplied by 1.1 again. This gives me 2420. Then I go again. 2662. Then I go again. That gives me 2928. All right.
Yes.
I just rounded it. There's a 0.2, okay?
Yes.
But I just rounded it. 2928. Then I go again. That is 3221. Is that not it? 0.02, but I mean, so these are the increments. And they said that the working capital is 10%. Is that not it? So this will be 220, 242, 266.2. I'll ignore the 0.2. So here will be 293. All right. And here will be 322. Now let's do our movement. How will the movement be? We've shown it before, right? Then in the last year, we will recover everything. So it means our first year is how much? 220. This is what? 22, right? The difference between this one and this
22.
one.
It's 22.
So this one will be 24. What is the difference between this and this? That's like 27. Then the difference between this and this, That's like 29. Then we will recoup everything, 322 at the end. All right. So this will be the working capital we will take to our investment appraiser. So take note of that. This will be our working capital incorporation. So how do we set up our investment appraiser? So we have here, we start with, let's say year 0, 1, 2, 3, 4, and 5. All right. We start investment appraisal like the way we do P&L. So you will start with your revenues. So revenue. The revenue, we know that year 1 is 2,200. You already know them because we did it in the workings. All right. So you just slot them. These are your revenues. And anytime you get revenue, you less expenses, less cost of sales. All right. So you less all costs. In this question, what are the costs? The cost started with wage cost. So you say wages. The wages was quoted in real term at 0.4. So in money terms, first year will be how much? We are less in expenses. So 0.4 first year, what is the inflation rate for wage? Is 5%. Have you seen that?
Yes, sir.
It's 5%. The revenue was 10%, and we are done 10% already. So that's why we didn't waste time. All right. And that it was 10%, 10%. So you saw it. All right. So 5%, 0.4 by 1.05. What do you get? That is like, is how much? 420.
Yes.
So, we move.
441.
441. Next.
463.
463. There is a 0.05, but we are rounding. Okay, it's an expense. So next.
486.
486.
511.
511. So that is our what do we call it? Our wage. There was another expense, which is maintenance. So let's do maintenance. Let's do our maintenance. It says that, yeah, and will also require expenditure to maintain the asset. So that one is a maintenance. Yeah, that one is maintenance. So how much is that? That one too is inflating how many times? The asset. 7%.
Yes.
So
7%.
put 5% here, you can put 7%. So let's go. This one was quoted in real. So we start with its nominal. How much is that?
321.
321.
344.
344.
368.
368.
393.
393.
421.
421. All right. So this is the expenses. So you have them. But we also did working capital movement. So the working capital. So you bring in. So normally when you finish with your expenses, then you come in with your capex, your capital expenditure. All right. And the capital expenditure was 4,500. It's an outflow. Don't forget that. Then you bring in your working capital. I'll give you the format as we develop the advanced format. All right. So as we develop, you will see it. So the working capital this year was how much? 220 at year 0. At year 1, let me scroll down a little so that we can copy them. It's 22.
22.
Here is 24. We have 27, 29. Then we recoup it at the last date at 322. All right. So basically that is that. There was no residual value, nothing. So we will total everything, and the figure that we will get is called net cash flow. the free cash flows or the net cash flows. All right, free cash flow or net cash flow. So when you add this one up, you have 4720. Okay. Then when you do this side too, how much will you get? So someone should also pick those any of the years and calculate for us. Stephen, I've not heard from you today. Combat, I've not heard from you today. Rachel is not also over here. And who else is not there? David is not here. Konate is not here. Quincy, Cornelius, your colleague, is all right. So any of them, whichever you have done, let me know, and we will go and read the discount factors.
First year 1437.
Which year?
First year 1.
1437. Okay.
The year 5.
2611. 2611.
Year 2 1611.
1611.
Year 3 1804.
1804.
The year 4 2020.
2020. All right. So now we need to go and read a discount factor. The discount factor, when we worked it, we had 15, right?
Yeah.
Yes, 50%.
So let's go downstairs, the table that will be given to you in the exams, and go and read discount factor for 15%. So when you are doing the check the formula. Okay, so this is the discount factor formula for 15% is here. So year 0 is 1.00. Year 1, what do you see? 0.87, right? 870. Year 3, year 2, sorry, 0.756. We are reading from here. 0.658, 0.572, then 0.497. All right, so we can now multiply them and get our, don't forget this one is in negative. So let's get our NPV.
But Thomas, the year 5, the wage cost.
I
had 510.
You had 510, okay. But anyone, well, it's understood. My own is that you get your process correct. If you had it, then it means this side will be something like 262, right? Or 260.
Yeah, 12. Yeah.
Okay. Yeah, 2612. Yeah. So, but well, like I said, FM there is plus or minus 1, so you always be in the range. Okay, because of the approximations that is always in FM.
So the year 5 is 1297.6, so 98.
This side.
Yeah.
So you said you had what? 1298.
1298.
All right.
Yeah.
So the others, yes, let's finish it off.
Year 4 1155.
1155.
55. Year 3 1187.
1187. What figure was here?
Year 2 1218.
1218 and
1250.
1250. So when you add them all up, what will be the NPV? So this figure that you had is the PVs. The PVs that you had. So when you add it, sigma PV will be what? When you add everything together, you add 13 positive or negative?
8 positive.
Positive.
All right, that means that the project should be accepted. All right, the project should be accepted. Don't forget the question that we were doing is in millions, okay? So whenever you get it, remember to put the millions too. All right. The question we were doing was in million. So it means you can put, and we took 3 zeros off. So if you want to bring it back, you can add it, or you can also put 0 zeros at the top. All right. Okay, so basically that is that. The question, what was the name of the question? We didn't have a proper name because I want to go back to the page. The question was, let me try page 150 or something. No, this, let me go up.
The table, the one for reading the discount factors, you can just download it from Google, right? Because some of them I was seeing other ones
So you
that
can
the
download
numbers
it from where?
from Google, right?
Oh, you can get it anywhere, but it will be given to you in the exams.
I
So
mean for personal use.
for personal use, I have one behind the book.
Okay.
The last page of the book. That's the one we use right now. All right. So that is that. Okay. So it meant that everything we were doing, it was in million. So we added the zero. So you have to make sure that you put here that the figures are in CDs, 00.
Thomas, my book doesn't have it.
Your FM book doesn't have it. Really?
Okay,
Check.
I've seen it.
It's not.
I've seen it. I've seen it. I've seen it.
All right. So that is that. Okay. That is that. So the next time we meet, we are going to now factor in how we bring in tax. But before then, this is your assignment. This is your this question 2 is your assignment. Repeat the process, and this one you are going to do from the scratch. So you do NPV, you do IRR, you do return on capital employed, where we are using the accounting rate based on average investment. I hope you remember those ones. We also did discounted payback. Now it says that C, from your findings in B, advise whether the investment is acceptable or not. So you see, everything here we have done it. Is that not it? We've done everything here. So even though in the book you will see a solution, I don't want you to focus on the solution. Please use the principles you have learned. Remember that in investment appraiser, we use DCFs, discounted cash flows. We use relevant cash flows. So it means if you have a fixed cost that is always remaining constant, you have to ignore it. Fixed cost that is remaining constant all the time, it is not relevant because it is not incremental. Be very, very careful about those things. But a fixed cost that is suffering inflation is not a fixed cost because it is changing with the inflation rate. So be careful. All right. It is not all fixed costs that are irrelevant. Hey, be careful. And so in MA, it's a question they normally ask. Explain the concept. Fixed cost is always not irrelevant. Or fixed cost is always not relevant. Explain it. So, sorry, it's always not irrelevant. Explain. So please, if the fixed cost is incremental, it is relevant. So take a look at it, solve the questions, of course. And I have a question which I know that this question, many people will copy the answer for me from the book. But so there is a question I didn't provide the answer. I said try it on your own. If you're able to get this answer, this is the answer. If you're able to get it, then it means you really understand what we are doing. But when you are reading the question, read it well because there's a little trick. The expenditure of 1.3 will be required to replace the existing asset, which will now be used in the project, but getting to the end of its useful life. Read this statement very, very well and give me the answer. If you don't get this answer, it means you have not understood it yet. So be careful. All right. Be very, very, very careful. So when we meet, we will go to, I know this one that those of you who have the book, you copy the solution for me. So I'm not interested in this one. Just solve it and compare the answer. When we meet, we will be focusing on what you did. Try your own question. Yeah, I know. So I decide to put in my books some questions where I give you the final answer. You have to work it and see. Please, today is Sunday. You have by Thursday to send me your solution. I want to see your solution. Send it to me via WhatsApp. All right. So
For the two of them, or
no,
for the
no. The first one, you can see your own fate by looking at the answer in the book. But this one, I want to see what you get.
no, but
And if you do
we're
it and
not
you send
looking
to
at
me,
the
I will look
solution.
at it. If you do it and you send to me, I will look at it for you. And we will discuss it. All right. So basically that is that. So the next time we meet, once we go through the question, we are now going to see how we bring in taxation and capital allowance. All right. Then when we finish taxation and capital allowance, you will see the full way we do investment appraisal. This is the format. So you start from here with your net trading revenue, and I'll show you. Yeah, so this is the format you will present. All right. And remember, we've done delayed annuity and advanced annuity, delayed perpetuity and advanced perpetuity. So you will see, we will bring everything together into an investment appraiser question. All right. So that we are done with the investment appraiser. All right. So thank you very much for your time. I said I will use only 1 hour, but it looks as if I've gone past the 1 hour. All right. So see yourself in this one on the YouTube channel. Thank you.